Gina was just saying we get together to solve problems. We're just going to fix the future of capitalism in this session, or maybe just take a bite out of it. When you study economics, the textbook that you have, the first chapter introduces students to the market and the state. Then there's a bunch about supply, demand, goods and services, savings and investment, elasticities, all those things. But it keeps coming back to that line that you draw between the market and the state. How the market can work with the state to produce the most productive use of resources, but in a way that also makes people feel that it's working for them. And we keep coming back to that in one way or another at these forums, and I think we're going to keep sort of taking bites out of it. But I want to think about that balance and how we're sort of shifting our ideas of how a market and state can work together, particularly when it comes to the financial markets, which is so important to many people in this room. And we have this terrific panel to think about how we can build resilience, make people feel more engaged in the financial system, and sort of just produce better economic outcomes. Let me start with you, Raf, and you have asked me to call you Raf.
Yep.
You're in a really interesting position because you are investing on behalf of, you're investing public money, the Australian Sovereign Wealth Fund, and the conversations we've had, I know you've had an evolution in how you think about that job and how, as you scour the world, what you're looking for in that right kind of balance between market and state and a healthy economy for investors. So just talk us through a little bit of that.
Yeah, thanks. So I guess I sit in the nexus of, I'm a public servant, I work for the government, and I work in financial markets. So
you're the perfect guest for the Economy Forum.
You know, maybe the invisible hand's a bit too invisible at the moment, I think. Like this system we've got is for sure the best system there is to allocate resources, create jobs, grow wealth, grow the pie for everyone. But it's far from perfect. And if you look back at human history, firstly, I'd say capitalism hasn't existed for very long in its current form. And secondly, it doesn't get things right very regularly in terms of it moves forward, it moves back, governments regulate more, less, people feel they're participating or not. We're certainly better off than we've ever been, and my colleagues here on the panel are examples of how we get the benefits of the financial systems out to the people. But I think one thing we've observed is we're moving into a phase now where, because of the huge leveraging of the economy really since World War II, and because we've had a series of crises in the last 20 years where the solutions have made rich people richer but not necessarily made young and working people participate in that, there's a rising view of inequality right around the world. And that's leading to more populist policy, more intervention in markets, and in general, that's a bad thing. It leads to lower growth, a smaller pie, more inflation, and that's not good for society. So we've been thinking quite hard, one, about how to invest into that world. You talk about resilience, but two, about what can be done to smooth that effect so that markets, governments step in the right way, but they don't break the system.
And where, just to follow up on that, I mean, where are you seeing that? What kind of, because obviously you, as an investor, you also just want to get the highest return for Australians, but what have you seen that seem to be helpful interventions to sort of make people feel there was more confidence in the system?
So I come from Australia. It's a great example. It's got amongst the highest median household net wealth in the world. I think it's second. Why? Because we have a compulsory savings system in superannuation. It's been around for 40 years now. That means everyone who works in any job has to put money away for their retirement. My 24 and 21-year-old kids, who are both in casual jobs, are already saving for their retirement. And not only that, they had to pick which fund to go with, so they did some research. So they've engaged with it. They get a statement every quarter. That makes a big difference. But I also think governments need to treat their constituents as educated grown-ups. You know, there's too much of this populist taking advantage of bias and short-termism, and we know that leads to poorer results. And so one of the things we've tried to do, we feel like as a government investment fund, it's our job not just to invest well, but to help everyone get better together. And so we've started to issue discussion papers on the issues we see in the world, the fundamental change that's going on, what that might lead to and what can be done about it.
Okay. David, I wanted to go to you because you've created the Nubank, and obviously in an environment in Brazil and Latin America that has a large number of unbanked, has potentially a lot of suspicion of financial products or just an exclusion from the financial system, and yet the bank has done extraordinarily well and democratized financial services for so many people. So how do you think about that, and what do you think some of the lessons are of the experience?
Sure, and I was thinking about the topic of the panel, and my answer related to this or specific example is capitalism needs a reboot in the direction of more capitalism, not less. And this is, I think, a good example of why I would say that. Across Latin America, you had 300 million people completely outside the banking system. And a lot of people tried to access it, they couldn't get it. Banks had no interest in serving consumers. There was effectively a banking oligopoly in every market. Today, you see around the world, this is actually a global, 5-6 banks owning 85-90% of the assets. So when you have that oligopoly, that means capitalism is actually not working. There is no competition. And some countries in Latin America decided that they wanted to use government banks to try to include all of these people into the financial services. That actually did not end up working. It was too expensive. People were not included. The government banks were not well managed. The flip side, what Brazil did very well was the regulators saw we need more competition. Technology, smartphone penetration around 2013 are creating this window of opportunity to bring more entrants, more startups, fintechs to compete with this big bank oligopoly. And they set up some very clear regulations and very well thought infrastructure about digital payments. And in our case, in 12 years, we've been able to bring over 40 million people to a banking system. We have contributed to decrease that concentration in the fee banks from 85% to 65% over 10 years. We've saved over $50 billion in fees that consumers, 100 million consumers, were paying to that big oligopoly. Now it's being distributed to more competitors, and it's being still saved in consumers' pockets. And ultimately, interest rates are coming down, financial inclusion is increasing, customer service is improving. So here, a shock of capitalism, where the government doubled down on more competition and fought that oligopoly, ended up delivering for the majority of the population. And I see that as a really good example of the role of the private sector and the public sector. There is a role for both. The government created this very clear regulatory environment and infrastructure, and then they let a lot of people go compete, created a market, and the best people at providing that service were able to win.
I mean, obviously, and whole books get written about the regulation, financial regulation, and how to balance that with allowing innovation. And you've presented it as a perfect example. It sounds almost too good to be true that the regulators would have hit on just the right amount to prevent any kind of problems coming from that kind of innovation. Usually, particularly in finance, you have a wave of innovation that produces enormous benefits, but there are a few crashes along the way. Latin America, we've had financial crises that have come after a period of great innovation or opening up of economies. So how was that avoided, or what mistakes have been learnt? Sure,
yeah, and I think you're totally right. So regulators always discuss or think about the balance between systemic risk and competition. And historically, due to the cycles, a lot of the focus was on systemic risk. And that meant prioritizing 4 or 5 banks that own effectively the entire market. You end up hurting access, you end up hurting a competition on that front. There was a change in view for regulators in the case of Brazil. We're saying, well, it's time to bet more on competition and let more people enter. And as 40, 50, 60 different banks went in and competed, there were certainly some that didn't work out. There were some bank failures, small bank failures, but it happened. That's part of capitalism ultimately, this creative destruction, right? You're going to have some big wins, you're going to have some failures. There's got to be a sense of enabling or allowing a number of failures, because otherwise you wouldn't get the big successes. But the flip side of that is the understanding that a very concentrated market is safe. It's actually also a misunderstanding, because you end up with this too big to fail type of bank. So while you have the appearance of systemic or low systemic risk on having a lot of concentrations, you end up having situations like you had in the US with the big financial crisis, where you end up with too big of to fail type of bank. So there's the right sense in the middle. Probably both extremes are careful. What you see in crypto, for example, in our areas of the world, a lot of fraud, a lot of entrance, a lot of speculation. That's probably too much on the extreme of too many people coming in. There is a right balance, but certainly a lot of the answers in some of these lacks of access is more competition, is more entry versus government trying to deliver products or services that the private sector should be trying to deliver.
I mean, Adena, you're sitting at Nasdaq. You know, obviously there's a context now in which we're talking about public-private, and this is the difference between public and private takes on a different meaning these days when we have private markets and private capital has become such a huge feature, and we had Mark Rowan on the stage yesterday. How do you see the sort of more traditional end of public capital markets being part of this approach and trying to sort of build people's trust in the system?
Well, I think first, I think it's important to recognize that the public markets are the most accessible markets in the world. So if you want to engage the entire population in the economy, then the public markets need to be vibrant and accessible to them. And you want to have companies want to go public so that they can, so that every citizen in a country has the opportunity to be an owner of those companies. And that is really, you know, what public markets are there to create for the economy. And I think as a result, we've thought a lot about what is the public company experience that we should have, how much regulation is the right amount of regulation for a company to go public and be public, how much regulation, and how do we think about investor protection and making sure that there are proper rules of the road for every player in the public markets to be able to operate, but also keep the investors always in the front of their mind. And I think that's where that balance of regulation on both issuance and the public company experience, as well as on trading and the public, you know, the public investment experience, is the most important, one of the most important roles the government can play. I think that in the United States, it has been interesting. I've started at Nasdaq 32 years ago, so I've been part of the growth of the economy and part of the growth of Nasdaq for many years, and I've seen a lot of different, I would say, cycles in terms of regulatory oversight. And it's hard to strike the right balance. If you think about a public company, they are beholden to their owners, and their owners are shareholders, and their shareholders are every citizen in the world. And they deserve to have the right to information. You know, there should be some transparency that every investor gets to have at the same time, so that there's no, you know, inherent bias or advantage that any investor has. You want to make sure that there's proper liquidity so that you can get in and out of those companies freely. You can make those investment choices at any second of the day, and you can execute those trades successfully. And then you need to have integrity. You need to make sure that there's market surveillance, and that there's trade surveillance, that there's anti-financial crime, and all the things that are necessary and proper rules of the road to make it so investors have the right experience. And that, I think, is what we think. You know, Nasdaq and the U.S. markets are the most liquid. You know, they're the deepest pool of liquidity in the world. And I think that over the decades of a capitalist system, the United States has pretty much struck the right balance. But today, the path to going public is a huge, it's like crossing a Rubicon. It is such a huge difference between being a private company and a public company. So how do we start to moderate those rules to give better access to companies who want to go public, who want to access those public investors? Thinking about the disclosure regime, probably there's too much disclosure. There's certain disclosures that are probably not necessary for an investor to make a proper investment decision. There's also the cadence of disclosure. Does every company need to report every quarter, or can there be semi-annual reporting for companies that have certain profiles? Also, then there's the proxy process, which if you ask any company who's public today, one of their least favorite things is the proxy process. And there's, for instance, you know, any individual who owns $2,000 worth of stock, I think it holds it for a year, can put a proposal on the proxy of a company. That's like saying every citizen in the United States gets to put a bill on the floor of Congress and force the Congress to debate and discuss and decide on it. It's democracy, but it's chaos. You know, so it's not. You have to think about what is the holding period and the level of investment that an investor should have before they can actually put a proposal on the proxy. What's the purpose of the proxy? How do you think about the proxy advisors and the role of them and the oversight of them? I think there needs to be more oversight. And then there's the third thing is the litigation environment in the United States. When you go public, you are subject to class action lawsuits from shareholders. And, we have a class action environment in the United States. But you have to say, is there another model that would work better? And the SEC chair has actually had the commission vote to say that for companies going public in the future, you can put in your prospectus that you are going to be subject to mandatory arbitration as opposed to a class action lawsuits. And that is a game-changing opportunity for companies to go public and know that there is an avenue for disputes, there is an avenue for shareholders to have an opportunity to express themselves, but it's in a way that's, I would say that it's more consistent with the public company model. We, as an industry, are subject to mandatory arbitration, so kind of bringing that into the public company model also, I think, is really important. So those are the types of things that create a better balance and make it so more companies want to cross that Rubicon and be part of the public markets.
The administration is, I think, has sort of in general had a stance of wanting to liberalise a bit more, potentially could be answering some of your concerns, and also increase liquidity in the market, have more trading, all of those things. There seems to be some support for that. But at the same time, there's also a desire to be very hands-off in relation to things that have inspired some nervousness, crypto and a lot of that innovation. So I just wonder, how do you think about that balance?
Well, what we advocate for in Washington is always what's right for the investor. And we talk a lot about that idea of liquidity, transparency, and integrity. And those are the three ingredients to a successful market, but they need all three. So if you're a private market, then you don't necessarily have the level of transparency and liquidity that makes it so that every investor necessarily is, should have those investments should not necessarily be available to every investor unless you're able to provide that liquid and transparent model. And then you need to start to think about what are the rules of the road to opening up those private markets to the everyday investors, because they deserve that. I think when it comes to the crypto markets, the SEC and the CFTC, the legislature, they're all grappling with what are the rules of the road that they want to create for this new asset class. Is there a model that harmonizes between a security and a commodity? Are these securities, are these commodities? How do you therefore kind of regulate and oversee them? And there's a big debate that's underway in the United States around that. We're very happy that there is a debate, that there's actually a discussion and a pragmatic way of thinking about how this asset class should be governed and regulated, because it's becoming a big part of the it's a part of the retail investor experience, and there are no rules of the road today. And as you said, that gives rise to a lot of negative consequences. So how do we bring them into a regulated environment while you allow for innovation, but you also put proper oversight and the rules of the road that allow it to investors to have the right experience? And that's the debate that's underway right now.
And just to remind you, I'll have the questions coming through if you want to scan the QR code and offer some questions.
Can I ask, though, did your sons, which fund did they decide to invest in? I've been wondering.
Look, I would just say all of the big super funds in Australia are excellently run. I know all the stuff.
But on that, though, I mean, well, as I had so many questions to ask you, but Raph, if you are looking, and obviously you're thinking in terms of countries as well as individual investments, what your portfolio geographical allocations are. But Adena talks about the importance of integrity, transparency, liquidity in markets. If you look at the combination of those things in the US now, in the mix of US markets and the administration's approach, does that look like a resilient system for you? Do you feel like it's moving in the right direction?
Well, I think that's a leading question, but it's very volatile and unpredictable. And I think, there's a few markets maybe belling the cat, we say, about where we're at in the cycle. One is you talked about litigation funding. Litigation funding is now an institutional asset class. I can invest in litigation funding. Do you think that's a good sign or a bad sign? I'm saying it's a bad sign. Because I invest in the companies that are getting sued too. Mm-hmm. Right? So I think if we just have clear rules, they spread wealth and, as you say, transparency, and people can make informed decisions, that's the point, then we're all better off. Otherwise, we're just paying lawyers. or maybe institutional funders of lawyers. Look, the US has been a remarkable economy and a remarkable market, and it's done incredibly well since World War II. And we have an extremely large exposure. It's almost half the portfolio, and we've benefited greatly from that, as has the world. But the reality is that at the same time that the rest of the world is growing faster than the US, so while the US still has the biggest economy in the world, it's a smaller proportion of the world. Same with the capital markets, except in the last few years, obviously, with the tech boom and AI, we've had a concentration. The rules of the game are at risk and are changing, and for a non-American global investor, we want to know what are the rules around trade, capital flows, taxes, regulation, and they are changing, and they're changing with not much predictability, and that does concern us. And as a sovereign investor into the US, some of the retaliatory tax provisions in the One Big Beautiful Bill Act, which were repealed, really alarmed us. And as a result of that and some of the volatility we've seen around trade policy, after Liberation Day, we've already made the decision to reduce our US exposure and have done that and continue to do that. That's not to say that we don't think there are great opportunities in the US. It will remain our largest exposure, but it's just a riskier place to invest than it used to be, and we've lifted the expected return we need as a result.
There seems to me, there is a tension. I mean, we talked about, and I want to sort of keep coming back to this idea of also, you know, some of the populism we've seen, and Raph, you talked about the pressure that's come from the increase in inequality and the people feeling that the system has not worked for them. And the moves that you would make that people might support on this panel to engage people more in the markets are often about making it more accessible, more fun, have people feel like they're engaged in the process. But some of the most fun investments are not necessarily ones that are going to go into the most productive uses for the economy, and they may indeed you end up getting burnt. So I mean, how does one think about the balance? Because you want people to be engaged, but you do also want there to be a path to long-term investing and not to be having it be completely a game.
Yeah, I think the first thing is access, is people across all different segments being able to know that they can access the equities markets or the fixed income markets or the crypto markets. And I think a lot of the new fintechs in a lot of the different platforms have been able to provide that access. But then that has to come right next with a lot of financial education and products that are very easily to understand. And then there are certain business models that are very incentivizes speculation, and that's, I think, when a lot of people end up getting hurt. Incentivizing speculation versus long-term investing. In our case, for example, we have one of the largest crypto platforms and investment platforms in Brazil, but we, instead of showing 700 different crypto assets, we pick 5. The 5 that we would ourselves invest our money and our kids' money behind, and we add a lot of education and expertise to the different people that are participating in the platform. And so far, I think people have been able to invest and create wealth. But the flip side of that is that there is an instinct to avoid people getting into hurt or buying investing is removing access completely and making it almost illegal, which was what's happening in the US over the past 4 years. Crypto was this asset class that nobody wanted to talk about. Everybody was investing, but it was almost like this, it was effectively a black market. And so there again, there's a balance here. You have to provide access, you have to provide disclosure, but the answer is neither let 1,000 flowers bloom or create black markets or make it illegal, because ultimately people will find a way to get in.
But is liquidity always the answer? I just think you talk about your kids, you know, they can't take the money out. They can be engaged in choosing, but it's inherently a long-term
They can't take, at least under the current rules, they can't take the money out until they're 65. So for my oldest child, that's in 41 years. And, you know, compound interest works. I think one of the issues, like we're talking about the issues with the system from within the system, but one of the issues I observe is the capitalist system doesn't really think intergenerationally very well. You know, it gives wealth, or if you take risk, to people who already have it. have built it up through their lifetime. And so how to engage the younger generations in the possibility, but also help them participate is critical here, because we can complain about the regulators, but the regulators, such as we think they're over-regulating, are responding to the policymakers, and in a democracy, they're responding to the voters. And so we need to spread the wealth. We're growing the whole pie for the whole population, and if you can save for your retirement or access funding because you've got an idea you want to start a business or grow a business, that's how you grow the pie.
I think it's important to recognize that there's a role for different types of duration of investing. There's a different type. So, for instance, there's 401ks and there are pension funds that help people save for retirement. The superannuation funds are an incredible creation. They are an incredible creation. I think that if we were to kind of restart the United States, that would be a model that we should really kind of lean in on, because it allows everyone to have an opportunity to engage in the economy, to be an owner of the economy for their life. And then it kind of creates that safety net, that kind of nest egg that allows them to know that they can live their lives with some security. And then at the same time, they then have their annual income and they can decide whether or not they want to do things that are in a shorter term, and they want to engage in the markets in a different way and invest in maybe some things that are more speculative, maybe some things that are really exciting to them, maybe some things that are long-term dividend, income generators. But that's what's so great about the public markets, is that you have the opportunity to do all of that. And having all of those mechanisms available, I think, is the most important thing that an economy and a government can create for their population. So it is it is an incredible model, what's been created in Australia. We in the United States, we have about 58% of American households own equities, but that means 42% don't. And if you think about that bifurcation of wealth that's being created as a result of that, it's actually something that I think systemically we need to address. And there is something that came out of the Big Beautiful Bill that is actually really interesting, which is the America Invest program. Where every newborn starting January 1st in the United States is going to be given a $1,000 investment account that's going to be professionally managed through essentially index funds. And they will not be able to take that money out until they're 18. So they have 18 years of compounding returns. And that will give them a chance then to have income for education, for housing, for things that are important to them as they enter their adult lives. But it gets them engaged in the U.S. economy in a way that just doesn't happen today. So it is one of the most innovative things that we've seen coming into the financial system in a long time in the United States, and we're very excited about it.
It's quite innovative, although I think Gordon Brown would recognise it as what he introduced in the UK. We had the baby bonds, which was exactly this model that was in place in that administration before the global financial crisis and George Osborne. So I think it'd be fascinating that this is now being picked up by the Trump administration.
But I think it's a little different, I would say, only because it's an equity account instead of a bond account. So you become an owner. You become an owner in these companies, and then what I really like about the program is they're going to have an app that allows them to see not just that they're invested in the S&P 500, but they're going to see all 500 stocks they're invested in.
It was in shares. It was just called a baby bond, but
okay, good.
Choose between bonds,
which is great. That is, I think, such an important creation and it's going to have this long legacy, I think, of engaging the population in a way that's never been engaged before. So the more we can come up with those types of innovative approaches to get the population of every country more engaged in the economy, I think the better off our economy will be.
We have there's a few questions, and we've run out of time, so it has to be very quick fire because I think that they're good questions. There's a couple of people who are interested in how can governments encourage long-term investing. We've been talking a bit about that. But Adena specifically, Ian MacDonald is interested in and so am I, on the proposal to drop quarterly reporting, because I think certainly people in this room would see both sides of that.
Yeah, I know, and there are two sides to it. So I think we are supportive of the notion of thinking about a different disclosure regime. And we think about it really, is a one-size-fits-all model the best model for every public company in the United States? We have 4,000 listed companies, and is every company really, do investors need that? So I'll give you prime example are biotech companies. And we are the market for biotech. We're really proud of that at Nasdaq. But biotech companies can go years without much change in their financial profile as they're developing and going through. And any sort of change in their financial profile would be subject to an 8K. I mean, they have material. If a trial goes well, if a trial goes poorly, they have to report that. But every single quarter, they have to go through this incredible process of putting together the financials, getting them audited, going through the prep for an earnings call, and then communicating with their shareholders, when it's probably nothing much is changing, but it's a huge tax on being that company, where they're still trying to survive until they can generate revenue. And I'm not sure that that quarterly process is really appropriate for a company of that, in that kind of that mode. And we have thousands of companies that are small companies that are just trying to make their way, and they want to give their access, they want to have ownership of every citizen, but they also need to figure out how to earn their way into growth. And I just want to point out, small companies right now are paying on average 40% of their earnings in interest expense. So if they are having to pay 40% of their earnings in interest expense, which, by the way, went way up in the last few years, right, because the interest expense went way up, and that most of them are short-term borrowers and variable rate borrowers. So you've got that going on. Then on top of that, you've got this incredible cost of being a public company. It's a huge tax that makes it so that they're less competitive with their larger peers. And so anything we can do to try to moderate that and think differently, I think is important for us to have that discussion and debate. Right. So we see it as a way. I heard one investor say, great investors don't need the quarterly process. Like, they should be able to understand the overall nature, especially in a long-term orientation, of what is happening in the company. And the 8K process will continue to be required for material non-public information.
I'm going to take this next question, which has to be very rapid fire. I'm going to take that as your answer. I'm going to take it as your answer, what you've just said to this question, and the others to get a quick response. Which part of the existing financial markets do you want to change or eliminate if you have a magic wand?
I think we should be growing value, not trading, for the long run. So I agree on the quarterly reporting. We don't need it. We don't want it.
Okay. David, magic wand?
I think a magic wand is going to be tokenization of assets. And what tokenization really enables is going to be an unbelievable increase in terms of the availability of different investment types and access to a lot of different markets. Brazil or Latin America, for example, has very little access to the world capital markets. With tokenization, you're going to be able to have Singaporean investors buying credit card receivables of a Brazilian city. You're going to have all of these with a lot of transparency in a centralized market around the world. So I think that will solve a lot of the liquidity, that will solve a lot of the access, that could provide a lot of transparency, and that might be a big facilitator of flowing or taking capital to areas of the world that does not have access to that type of capital.
Exciting and upbeat ends to the panel. Thank you very much, all three of you.
Thank you.